Hello, and thank you for joining me for a brief 7-minute discussion with Seidel's Chief Investment Officer, Arthur Heinma. My name is Megan Duncan, and I am a Senior Associate at Seidel. Today, we will be discussing three items as we look ahead to 2021: a market outlook, substitutes for traditional fixed income, and potential positive and negative events that may impact investors in the coming years. Arthur, I think we can all agree that we've come a long way since the equity market depths of March and April. Who would have predicted Canadian bonds would return 8% in 2020? How do you see the markets looking over the next few years?
Well, first of all, I think bonds would be challenged to produce anything approaching the 8%. I mean, to get anything beyond the coupon, you're going to have to expect that interest rates are going to go zero, and not only to zero, but well below zero to even get close to what we saw last year. Don't look for bonds to perform like that again. And in terms of the equity market, the fate or the extent to which the equity market does well is going to rest on very much on the shoulders of fiscal stimulus. First, in the short term, you're going to need the continued transfers to many of the unemployed in the US and in Canada and in Europe. To give you an idea, currently there are 10 million people unemployed in the US, and at current job rate creation rates, it'll take well over 2 years to bring us back to where we were in 2019, let alone to grow the employment number beyond that. The second piece of fiscal stimulus is really going to be on infrastructure spending, and that'll support the recovery for years to come. In the absence of those, it's going to be challenging to see anything other than mid-single digit returns in the equity market.
And while bonds have had solid returns in 2020, there's been a lot of conversation surrounding the role of bonds in client portfolios, with interest rates being so low moving forward. Can you discuss the substitutes available for traditional fixed income portfolios?
The big reason for holding bonds or fixed income in portfolios has been to reduce the risk in portfolios. They've been shown low correlation or low correlation with equity markets. But at this point now, you're getting very, very little return. When you look at it after taxes and inflation, you actually have a negative return. So now you're getting return-free risk as opposed to risk-free return for government bonds, which means you have to look into other areas. And you have to look at those areas not in isolation, but in context of your overall portfolio and asset allocation. And the two areas to really look at are going to be alternative investments. That means hedge funds, private equity, infrastructure investment. And we have those types of investments available to our clients. And the second would be looking at high yield equities that have very strong balance sheets and are able to sustain those equities. In many instances right now, in those high yield equities, you can get multiples of what the government bonds yield, and actually multiples of what their own bonds yield for over a 10-year period, both of which will help augment that running yield for portfolios.
Okay, perfect. That's very helpful. Thank you. And with the new president and vaccines being delivered as we speak, many now have reasons to be optimistic. Let's discuss two potential developments that are possible concerns, and conversely, a few upside surprises for investors that may lie ahead.
Well, one of the concerns I've already spoken about, and I think it is one that really watching that deals with fiscal stimulus. If you look at the experience coming out of the financial crisis, both in Europe and in the United States, they withdrew fiscal stimulus too early, and it led to very, very slow recovery, where many of the GDP, the nominal GDP, didn't get back to where it was before the fiscal crisis for many years afterwards. And will be subject to the same fate unless governments continue the fiscal stimulus even as the economy recovers. As you recall, the central banks have very little room now to lower rates because rates are effectively at zero. And unless we're going to plumb to depths of negative interest rates here in North America, there's nothing to be done on that side. So that's going to be one area to watch. The second one, it really has to do with the recovery that's been priced into the marketplace. We see the infection rates going up here in North America and in Europe. It's not a stretch to see a very weak first quarter and even the second quarter as vaccines are being rolled out, but death tolls mount and economic growth it remains challenged, both of which will be difficult for the equities to maintain those valuations that they priced in a very robust recovery. On the positive side, there are two things that are really pointing to optimism, certainly in the next decade. And the first one, what I argue, has really been what you've seen in terms of the green revolution. You've seen, a virtual collapse in solar prices, in wind prices. So the whole renewable sector is going to displace a lot of energy. Indeed, forecasts now are looking for almost 30% of the vehicles in developed markets to be electric by 2030. This present, represents a huge investment opportunity and a big shift in the society overall. The second thing that could surprise is really the strength of the consumer spending in the latter half of this year. As soon as the vaccine's been distributed throughout the market and the checkered flag has been waved, that everything that we've reached the end of the COVID period, I think particularly consumers whose balance sheets have improved. So that means all the high income earners who really haven't had the same kind of COVID experience as the lower paid service workers. They've been chomping at the bit to spend, and the spending could actually be much higher than expected. So the opportunities could be in high-end consumer products, high-end consumer services, where they participate in that kind of recovery. And it wouldn't surprise me to see that as a big relief at the end of this year.
Okay, that's great. Thank you. It's nice to know there's various reasons for us to look forward to 2021 and put 2020 behind us. Thank you for your insight and your expertise. And thank you to our audience for joining our discussion. We hope you found it helpful and informative. If you have any questions or would like additional information, please reach out to your Seidel Wealth Consultant. Thank you.